Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Monday, April 27th, 2020. And our top stories today, we'll take a look back at the first quarter of 2020 and see how markets fared. And then we'll take a look and see how stable value funds and target date funds fared as well. Joining me now, Senior Vice President and Chief Investment Officer for ICMA RC, a very important record-keeping corporation in the U.S. retirement record-keeping space. Wayne, thanks so much for joining us on the program this morning.
My pleasure, Jeff. Nice to see you today.
It's great to see you. And before we kind of jump into markets, and I want to talk to you about a lot of different issues, how's the team at ICMA RC doing? You have operations, a base of operations in D.C., but you also have a relatively newer office in Richmond, Virginia. How's everyone doing?
Well, we have those two offices. I think everybody has really confirmed their ability to work well at home. It's been somewhat seamless, quite frankly. And obviously with people all over the country, they're always used to working remotely. But for corporate America and all your viewers, obviously this has been a very different way of life over the last 5 or 6 weeks.
Yeah, certainly. And we certainly appreciate you coming on. We know you're extremely busy and have a lot of responsibilities. So let's jump right in. Obviously, we've seen a lot of volatility in the market over the last 6, 7, 8 weeks. Seen the market go up and down. Really very unnerving if you are an institutional investor, but also an individual investor. What's your assessment of this market?
So, we've never had something quite like this before. Everybody tries to compare this to other significant market dislocations, but this is really different. And I think that, as many people and some of your guests have talked about, this is a health crisis that's precipitated what is going to be a longer economic road. So I think that some of that volatility that we see in the markets today certainly was initially caused by the uncertainty of a medical problem as opposed to a financial or an economic problem. I think as time has gone on, as we get a handle on some of the issues there, people get a little more comfortable with some of the progress that's being made. And I think, markets being what they will, equity markets have jumped way ahead in terms of looking to what could be in the next year and a half, based on all the stimulus that is going on. Fixed income markets, on the other hand, as you look at treasuries, are not overlooking the fact that over the next few months, the economy here in the United States, as well as globally, is going to be a challenge.
Yeah, it certainly seems that way just from the layperson's point of view. And your organization works with a lot of different types of organizations, but specifically governmental entities, so municipalities, states, et cetera, but also not-for-profit institutions. Are you hearing anything from clients or participants in these retirement programs that kind of, talk about what people are thinking?
Well, I think that whether you work for a city management organization or you're a teacher in one of our 403B plans, we're all in the same boat. We're all concerned first and foremost about the health of our families and our coworkers. And then secondarily, we have to think about how are we going to continue to move forward in the occupations that we have. Public sector employees, as you know, really are playing a significant role in this health crisis. They are on the front lines, and our organization is certainly very cognizant of doing whatever we can to help all those first responders and those that are helping everyone in need at the moment.
So when you look at the volatility, you look at the markets, and we're recording this on a Tuesday, kind of before this airs, so there could be some things that happen in between now when this airs on Monday. But let's assume that the market continues to, we're back up close to 24,000 in the Dow Jones Industrial Average. But longer term, in terms of a potential recovery, first we have to get Americans back to work, and that presumably will happen in a staggered fashion over time, depending on what state, what region, what county you're living in. Does that factor in from an investment point of view? And again, I don't want you to speak necessarily for your team, but just generally, broadly, does that really factor in that staggered approach to returning people to work? Does that factor into investment decisions?
Oh, of course. I mean, you have to think about the impact of so many people. You know, we've had over 22 million people apply for initial claims in unemployment over the last 3 weeks. Given the fact that 70% of our economy is in service sectors, that has a lot to do with the ability for companies, whether they are large or small, to earn a profit over a period of time. So I think as we are thinking about the longer term prospects for equities in particular, that certainly has a significant input into how long is it going to be until we return to normalized earnings growth? Is it going to be 6 months or 12 months or longer, by the way? So that is where we are in earnings season right now. Analysts are all trying to get a handle on without a lot of success, by the way.
Yeah, I think it's really hard. There's so much input data that we don't know and that we will not know. So it's kind of you kind of can go this direction or that direction or right down the middle, and you really have to hedge. You brought up the fixed income markets, and I think that's important to bring up because especially for the constituency that your organization serves. When it comes to municipal governments, they oftentimes will issue bonds. They have debt. That's very important for maintaining government functionality, for doing things like roads, supporting other important aspects of government. How do you see that municipal market and the fixed income market kind of shaping up?
Well, you know, the last 6 weeks in fixed income has been a real challenge. You know, we were hit with such illiquidity in February and early March. Markets are coming back to normal to a certain extent. Municipals in particular were hit very hard. And so that market is still in the process of trying to recover, much like corporate grade credits. So I think that if I'm a treasurer trying to fund a particular project, it's going to be a bit of a challenge here in the near term because there's just not that kind of appetite unless rates are extremely high, which obviously increase your funding costs. So yeah. I think right now CFOs and treasurers, they're all going to be pretty sensitive to changes in the market for issuance probably.
Yeah, and on top of that, tax revenue delayed in a lot of cases probably will be down because people are filing unemployment claims. So a lot to manage, and my hat's off to not only those government workers, and I know you feel the same way, and also the treasurers who have to deal with this and try to still provide services to state, local government citizens. Wayne, I want to hold you over for a quick minute. When we come back with Wayne, we're going to talk about his thoughts about stable value, guaranteed investments, and also target date funds. So you're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive FIBREX composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Wayne Wicker. He's Senior Vice President and Chief Investment Officer with ICMA RC, a notable retirement record keeper in the U.S. DC retirement system. Wayne, thanks so much for sticking around with us this morning.
Yeah, of course.
It's great to have you on. So we talked about the markets, and this is an ever-evolving thing, and no one really knows what is going to happen day to day, hour to hour, but really appreciate you giving us some insight there. What I want to do is break down 2 asset classes that are very important to retirement plans, and especially to U.S. public sector retirement plans. The first is stable value or guaranteed products. Wayne, how are you seeing things kind of shape up in this lower to zero rate interest environment?
Yeah, so I think, Jeff, you can look at this in 2 different ways. You can look at it as we like to think about it from our participants' viewpoint as an investor. And certainly in an environment here where treasuries today, 10-year treasuries are trading around 55 basis points, and we haven't seen anything over 1% for quite some time. The ability for a participant to get into stable value, which has a much higher crediting rate, really is a benefit in a low inflationary period of time such as today. I think that from someone who manages stable value, one of the things that we're always very sensitive, especially in the current environment, is how strong are the underlying insurance companies that we are doing business with. And so you have to spend a lot of time with our credit research teams trying to determine whether or not there has been any impairments given the current dislocations in the economy. So the good news is that in the stable value area where things are pretty darn conservative and guidelines are very, very tight, investors should probably feel pretty good about the fact that there really aren't a lot of occasions where you get into trouble in this very conservative environment, unlike maybe traditional intermediate core bonds or high yield, where volatility is going to play a lot more havoc in the short term.
And we did see, I think, going back to 2008, you and I both lived through that, and we saw a contraction. I think you were describing what we call wrap issuers. Those are the people that provide the guarantees. They're not people, they're companies that provide the guarantees. And we saw a contraction. We saw a lot of banks who were in the space kind of contract and get out, or liquidate and get out. How are you seeing the market react? And again, it's really too early to tell, and I think we'll know longer term. But in terms of that wrap capacity, doing that due diligence, is that something that you're not concerned about, but looking at very closely?
Yeah, so, you bring up the time you and I lived through 2008, 2009. You and I had conversations about that. And I think the world's a pretty different place today, where I think the underlying financial institutions that stable value providers deal with are in a much stronger position with regard to their balance sheets today than they may have been in 08. I think that regulatory guidelines as well as credit investment guidelines are much tighter today than they were. So when we think about wrap capacity and how it shrunk so dramatically in the 08-09 timeframe, I'm not anticipating that you'll see the same thing happen again here in 2020 for a couple of reasons. One, I think that because of all the strength in this business that I just cited, they're in a much better position. And 2, I think that given the type of crisis we're going through at the moment, we'll probably have the ability to come out the other side quicker than the unknown period of time in 08-09 timeframe that we lived through.
Yeah, I think you're right. We had the government kind of step in with the stimulus checks, CARES Act, all the things that we needed. You know, I go harken back to 2008 when it took a little bit of time to kind of ramp up the different programs that the Federal Reserve and the government enacted. Shifting gears real quick, Wayne, you know, target date funds, they have become really the predominant investment. They're literally the default investment for the majority of retirement programs, meaning people automatically defaulted in a lot of cases into a vintage that matches up with them. And we saw great evolution of target date funds from 2008 till now. In terms of the asset classes, though, are there things that target date fund managers are considering in terms of diversification to, again, alleviate some of that downside risk that we experience from time to time, we are experiencing now?
Well, I think that, there's a broad array of strategies out there, Jeff. You and I see them all the time. I think in the target date space, one of the most important things that those portfolio managers do is to develop that glide path. And, the slope of the glide path, and it's changed and evolved a lot over the last couple of decades, has been one of the biggest, I think, improvements probably for target date investors. So on the short end, for those that are getting more prepared for retirement, I think we've taken exposures in general down in terms of risky assets. On the longer term end, I think people are more willing to put even more equities than they originally did. So as much as it is the underlying asset categories that I think can help or hurt a target date fund family, it's maybe the slope of the glide path and the philosophy they have in terms of what they're trying to achieve in different economic environments, such as the one we're in right now.
And then retirement income, before the CARES Act, we had the Secure Act. And part of the Secure Act was annuitization and trying to find guaranteed retirement income, or at least guaranteed like retirement income. Do you see target date funds evolving once we get through this? We're past this, things are kind of ramping back up. We get in, maybe that's Q3, Q4 into Q1. But do you think product manufacturers out there building target date funds and building new investment products kind of start to rethink about some of these target date products and what income they produce?
Certainly. I think that especially in a low interest rate, low income environment like the one we have today, it's an ongoing problem that we've had over the last few years, where people who have to live on that interest income are having a harder time finding that. If you can develop a product that provides maybe a floor on that, or has supplemental ways to add to that income without taking inordinate amount of risk, certainly that is ideal. And I think that all target date fund families, as well as a broader array of financial service companies, are all looking to populate that category and improve them over time, I think.
Yeah, absolutely. I mean, we have seen improvement. Let's be fair. When they first were incepted, to the passage of the Pension Protection Act in 2006 to 2008, and even going forward. And I think people need to understand that it's an iterative process. And by the way, Wayne, as you know, I think there is no perfect investment. If there were, we would know what it is, and we'd be retired by now.
Right. That's exactly right.
Well, Wayne, thanks so much for joining us this morning. Really appreciate your insight. Stay safe. I'll give all my best to the ICMA RC team, and we look forward to having you back on the program very soon.
Hey, Jeff, thank you very much. Great to see you today.
And that wraps up this episode of BRN AM. Have a financial topic or someone of interest that you think we should talk to? Drop us a line. And don't forget, for all the news in retirement markets, technology, personal finance, and so much more, check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.